Good morning, everybody. Welcome to the San Diego chapter of AAII. My name is Rob Bernstein. I'm your chapter president, as well as president of RGB Capital Group, which is a registered investment advisor here in San Diego. I'm joined this morning by Bruce Ennis, who is a member of our chapter program committee, who will be assisting me with the webinar this morning. Our guest speaker this morning is Ben Johnson, who's Director of Global ETF Research and Passive Strategies Research at Morningstar. Thank you, Ben, for joining us this morning. Appreciate you being here with us. The plan for today, I'm going to share a few opening remarks about the chapter and upcoming events. I'll then move into a market update to see what Miss Market's been up to. And then, of course, we'll jump into our main presentation titled The Ins and Outs of Investing with ETFs. But before we get started, I did want to take a moment to thank the generous sponsorship that the chapters received from Jim Harper and Best and Krieger. The chapter incurs costs to host these webinars, and because of Best and Krieger's generous sponsorship, we were able to help minimize the financial impact on the chapter. As you know, we're not collecting any fees for participation in these webinars, so this is certainly a welcome and generous sponsorship that BB&K has provided. BB&K is a full-service law firm with a local office here in San Diego, as well as throughout California and in Washington, D.C. If you're looking for legal help, particularly with trust documents, wills, or really any estate matters, just ask that you at least consider BB&K and Jim Harper. Jim's contact information is on the screen. Jim's a regular member of our chapter and also posts his contact information in the chat once I get done with my opening remarks. So thank you, Jim, for your sponsorship. We really appreciate it. Please mark your calendars for these next two events that we have scheduled for our chapter. The next chapter event will be on July 10th. We'll feature Thomas Manganiello, I hope I've got that right, who's with the Securities and Exchange Commission. He'll provide an overview of the SEC. He'll discuss what they're working on, share information on different types of investment fraud that they're encountering these days, and most importantly, how to protect yourself. So I think he'll share some really valuable information that I think all investors need to know to protect themselves as we're all investing online and certainly exposed to some fraudulent activities out there. So you want to make sure you're protecting yourself. Then we don't have a meeting scheduled in August, but we'll be back in September with Tom McClellan, who is editor of the McClellan Market Report. If his name sounds familiar to you, that's probably because you're familiar with the McClellan oscillator. I've talked about it a few times in our risk management SIG over the years. The oscillator is a technical analysis tool that was developed by his father, Sherman McClellan. Tom has a unique way of looking at the markets, and you'll certainly learn something during his presentation, which he'll share with us, ways that he predicts the future of the market looking at different indicators and data. So it should be pretty interesting. In addition to our regularly scheduled main chapter events, we also hold special interest group meetings that meet on a regular basis. Our options trading group is run by Ryan McKeon, who's also our chapter secretary. There are no meetings currently scheduled for the options trading group. However, if you would like to review some of the past meetings, most of the presentations and recordings can be found on our chapter website. If you'd like to be included on the distribution list for this group, please let Ryan know by sending him an email, and we'd be happy to share and include you on those future communications. The other active SIG group that we have is our risk management group. This is a group that I run myself. The purpose of the group is really to explore techniques and different strategies and tools to help individuals, investors manage risk in their portfolios. Our next meeting will be held on Saturday morning, June 12th, starting at 9 a.m. Pacific time. We'll be looking at the power of investing in low volatility funds. We'll explore how these funds during the crisis last year. We'll evaluate how low volatility funds performed during the crisis, how individual investors could have avoided the majority of the decline, and how they provided some excellent risk-adjusted returns during the time period that followed the crisis. We'll also look at sort of what's providing some good risk-adjusted returns in today's market. as I outlined in my newsletter that I share with the group. So if any of that sounds interesting to you, please feel free to join us on June 12th. The registration link is currently posted on our website. If you look under the special interest group meetings and look at risk management, you'll find the link there. Also send out an email in the coming days and weeks with that registration link as well. Also invite any of the members of the SIG group, the risk management SIG group, to share their perspectives on the crisis last year, what worked for them, what didn't work for them, what did you do to protect your capital, what did you do to take advantage of the market following the initial crisis. So if you're interested in sharing your knowledge with the group, please let me know. I can reserve some time on the agenda for you. And just remember, this group is a group of like-minded investors, and we'll all learn from each other if we share our successes and failures. So please consider contributing during the meeting if you'd like to. I'd also like to remind everyone that the chapter does accept contributions to support the ongoing operations of the chapter. While the chapter is financially stable, we do incur ongoing costs to keep the chapter alive. If you're able to, please consider contributing to the chapter that has continuously provided investment education throughout this pandemic period. Even contributions of $5 or $10 can really help out quite a bit. So if you go to our chapter website, click on the Contribute Today button, you'll find that on most of the pages of the website. And also want to thank all of those who have contributed previously. It is much appreciated. And a very special thanks to those of you who have established monthly recurring contributions. Your generosity is greatly appreciated. So now I'd like to transfer over to a little market update. Let me see if I can get over to those slides. There we go. Bruce, you see the market update on the screen now?
That's good.
Okay, thank you. Again, this little segment is intended to be educational and for entertainment purposes only. Please don't take anything I say here today as investment advice. The trend of the large cap stock market is undeniably up. The S&P 500 continues to march higher, closing at an all-time high yesterday. This is despite the pretty sluggish jobs report that indicated that only about 266,000 jobs were created, a number far below what all the quote-unquote experts were estimating, which was a growth of 1 million new jobs. So, really shot well below that bar. The unemployment rate ticked up at 6.1% this month from 6% last month. You might think that news that the recovery is possibly slowing might put a damper on the stock market, but it looks like we might be in one of those periods where bad news is good news for the stock market. And that's because I believe that the stock market loves liquidity that's being pumped into the financial system. And that lackluster jobs report certainly gives the government some more cover to continue providing liquidity to the market. So when we think about liquidity, one of the ways that we can represent that liquidity is the Federal Reserve balance sheet. And as you can see on this chart, the Fed started providing liquidity even before the pandemic down in this area, certainly during the pandemic, but has continued to pump money into the financial system at unprecedented rates. Even this trend here, the balance sheet's growing about 18% per year. So they continue to pump tremendous amount of liquidity into the system, and that's certainly a lot of that ends up in the stock market. However, not all parts of the stock market are trending up at the same rate as large caps. This is a chart of the NASDAQ. While it's in a longer term uptrend, the intermediate trend I would consider more of a sideways trend. The index has hit a level of resistance multiple times this year and has not been able to penetrate this level. So eventually the sideways trend will be broken. We'll see if it breaks down or is able to break through that resistance level of R1. Small caps are also in a multi-month trading range and are at about the same level they were back in early March. So we're seeing another sort of intermediate term sideways trend in small caps. Much of the excitement in the financial markets, at least in my opinion, has been in the treasury market. Last time I provided a market update to all of you back in March, interest rates were surging higher. Rates went from 0.52% in early August to a peak of 1.74. This is the 10-year Treasury yield. That's over 200% increase in a pretty short period of time. However, rates have stabilized over the last month or so, as you can see here, and closed at 1.6% yesterday. However, I think it's important to put this recent surge into perspective because rates today are really near the pre-pandemic lows, shown here by this black line, which by historical standards are still extremely low. So this just gets us back to where we were prior to the pandemic. So I'm not too concerned about rising rates at this point. Certainly if this surge continued higher, that would certainly change my opinion. But right now, rates remain pretty low, and I don't think that's going to have a huge impact, at least in the short term. So with rates stabilizing, Treasury bonds obviously move in the opposite direction. So they've started to recover a little bit. This is a chart of the 7 to 10-year Treasury bond ETF called IEF. As you can see, with the recent stabilization in rates, Treasury bond prices are starting to rise a little bit. The recent rise in rates has had very little impact on one of my favorite areas of the market, which is the junk bond market. Junk bonds act as an excellent barometer of the overall health of the stock market. When they're trending up above their 50-day moving average, it's a sign that investors are willing to take on risk. However, if risk rises, junk bond investors demand higher yields to compensate them for additional risk. Of course, as junk bonds yields rise, the price of junk bonds falls. So that's why, junk bonds tend to fall during periods of higher risk, where Treasury bonds do exactly the opposite. But that's certainly not happening now, as you can see in this chart, and junk bonds are trending up nicely, indicating that risk remains relatively low. So in summary, the market's sending a few mixed signals, I think, with large caps and junk bonds trending up, technology and small caps kind of moving sideways. This divergence won't last forever. Once things sync up again, which they will eventually, we should have a better sense of the short-term trend of the stock market. I'm certainly going to be paying attention to what's happening with technology and small cap stocks to see if they can break out above those recent highs. So that's what's up with the market. Before I turn it over to Bruce to introduce our speaker, just a few administrative items. Just so you know, all your videos and microphones have been turned off. You will be able to ask questions, however, simply tap or click on your screen to make the menus visible. Look for the Q&A button on your screen to submit your questions online. I do ask that you hold off submitting questions towards the end of the presentation if you can, as we find that our speakers often answer some of our questions during the course of the presentation. So if you can hold off, that would be great. In addition, I've turned on the ability to what they call upvote a question. So if you see a question in the Q&A box that you're interested in as well, go ahead and give it a thumbs up, and that will help us prioritize which questions get presented in the event there are more questions than we have time for. A recording of the presentation will be made available and will be posted to our local chapter website early next week, along with a copy of the slides. So go ahead and check out AAIISanDiego.com early next week, and you should find both those recording and well as the slides available to you. Lastly, when you leave the meeting today, there will be a survey form. The screen should probably look something like this. If you can click on that button, we'd love to get your feedback on the presentation today. In particular, we'd like some feedback about your intentions to participate in our local chapter meetings once it's safe to meet in person again. Fortunately, we don't really have a timeline for that yet, but I think we're getting closer. We asked this question about 2 months ago, but a lot has changed in the last 2 months. So we'd appreciate you sharing your intentions once again. Your chapter leaders are considering providing both live in-person meeting along with a simultaneous live stream, and would love to hear, kind of what your preferences are going forward. So if you could take a few minutes to answer that, I would appreciate it. So with that, Bruce, let me turn it over to you so you can introduce our speaker.
Okay, thanks, Rob, and thanks everyone for being here this morning. And it's my pleasure to introduce our speaker today, Ben Johnson. Ben is the Director of Global ETF and Passive Strategies Research at Morningstar. And before assuming his current role, he was a Director of ETF Research for Europe and Asia. And he previously served as a Senior Quality Equity Analyst covering the agricultural and chemical industries. And before joining Morningstar, Ben, in 2006, Ben worked as a financial advisor for Morgan Stanley. He holds a bachelor's degree in economics from University of Wisconsin, and he is a holder of a chartered financial analyst designation. So it's my pleasure to introduce Ben Johnson.
Thanks, Bruce, and thanks first and foremost for the opportunity to spend time with everyone this morning, and thank you all for carving out some time on a Saturday morning to join me to talk through the ins and outs of investing with ETFs. But before I dive in, I just want to give one final public service announcement. Please, everyone, don't forget that tomorrow's Mother's Day. So queue up your calls, your cards, your gifts, your flowers, what have you. And if your wife is anything like mine, the one gift that she asked for is just a few hours in the morning away from everything that was involved in making her a mother to begin with. So the gift of silence, I guess. So with that PSA out of the way, let's dive in on today's topic, which again is the ins and outs of investing with ETFs. So what I plan to cover, and please know that I plan to try to reserve as much time as possible at the end for questions from you all, is here. And I'm going to spend quite a bit of time up front, really just on definitions. I think first and foremost, it's important for investors to understand what is an ETF? What is it literally? What is it relative to the other options that you have as an investor? What are ETFs not? So how do we define ETFs in the negative? From there, I'm going to transition into some of the benefits of ETFs and why investors would consider using them in their portfolio. I'll finish by highlighting a few of our favorite ETFs. So ETFs that carry positive Morningstar analyst ratings of gold, silver, or bronze. These are funds that we think are going to do well for investors over a long period of time for a variety of different reasons. So I'm going to share some of our very favorite ETFs from today's ETF menu to finish. And as I mentioned before, reserve as much time as I can to hear from you all, to hear what's on your mind, hear what questions you have, and try to give you good answers. So let's start with what is an ETF? And the only reason I really want to spend any amount of time on this is because there's just, I think, a tremendous amount of confusion that persists to this very day, despite the fact that ETFs in the US have been around now for nearly 3 decades. So I think if you think of defining ETFs in kind of a figurative sense, ETFs are really just an advancement in investment technology. They are a 21st century investing technology, and no different than any other type of technological advancement. What they do is they make our lives easier. They make things cheaper. They make them more widely available. They're a leveling force. They're a disintermediating force. They take a lot of frictions and a lot of middlemen out of the system, all to the benefit of the end investor. So no different than all of the many benefits that have accrued to us as people operating in a society, moving from landlines and fixed phones to now walking around carrying supercomputers in our pockets. ETFs are really just an advancement in investment technology. The way that investment strategies, be they index strategies or be they active strategies, are packaged and then subsequently delivered and consumed by the end investor. So what I would argue is that ETFs are really simultaneously a product of and a poster child for the information age. There is a lot of zeros and ones flowing over a lot of wires all around the world in real time each and every day that bring ETFs to life, that make them even possible. just the raw computing power needed to support this ecosystem that exists around ETFs. So if you think of index calculations, which in and of themselves are a derivative of the prices for all of the different securities that are included in an index, these indexes in turn underpin these funds, which are traded like stocks in real time. The amount of information it takes, the amount of sort of continuity, lack of interruption, real-time support, that simply wasn't possible years ago. Certainly, if you look back to the days of the slide rule, or the days before the decimalization of stock prices, the market just didn't have the IT infrastructure to support the ETF wrapper. And as I mentioned before, if you look at the success of ETFs, I would say it's reflective of just broader global trends towards greater transparency, lower costs, and disintermediation. In many ways, ETFs are kind of the Amazon Kindle to mutual funds local bookseller. So I think one of the most important things that investors need to understand about ETFs, and really the foundation of their advantages over open-ended mutual funds, has everything to do with the way that money flows into and flows out of the portfolio. And while that money is in there, how that money is moved around, how those buys and sells are executed by the portfolio manager. So most in the audience are probably very familiar with the way that mutual fund shares are either created or redeemed or destroyed, as the case might be. So we as investors go to the mutual fund company, we hand over our cash because we like the fund and we want to invest in it. We like the manager, we like their process, their track record, speaks to their capability, to their skill. We hand that cash over to the customer service department of the fund company. The fund company, in turn, tells the manager that there's new cash coming in the door and that they have to put that cash to work. So the manager goes about their business, adding to their portfolio, buying securities that they like, to invest our money to our benefit. Now, when, for whatever reason, we're done with that fund, the manager has delivered the goods, they've helped us to achieve our financial goals, and we're ready to spend against those goals, or otherwise the manager's fallen out of favor, or they've left the fund, we want our money back. When we want our money back, what that manager has to do is actually go out into the market, assuming that they don't have sufficient cash on hand, and sell securities. So they have to sell individual stocks, sell individual bonds in order to meet that redemption request. Now, what happens in the process, if outflows, if redemptions are sufficient, is that this can unlock taxable capital gains, which are ultimately distributed, ultimately shouldered by all shareholders in that mutual fund. Now, these frictions, and it's not just capital gains, but it's all of the transaction costs that are involved in all of this buying and selling, are ultimately absorbed by all mutual fund shareholders, not just those that are buying and selling. And this has been a real acute pain point for many investors, especially in actively managed equity mutual funds in recent years that have seen a huge amount of redemptions, investors asking for their money back, either because they've invested successfully with that fund or otherwise have chosen to do something different with their assets. And what that has created is massive capital gains distributions in many cases, which for investors in taxable settings, traditional brokerage account, investing directly with the mutual fund, have been a real pain point and a persistent pain point. So this kind of cash in, cash out proposition that is the mutual fund has real sort of negative externalities that can result based on the behavior of other investors in that same fund. Now, ETFs are different. ETFs are different specifically just in how you and I invest in ETF shares and how ETF shares are created and destroyed. So typically, most investors, most of us certainly, when we transact in ETF shares, we're buying and selling those shares on the stock exchange, no different than we would shares of Apple or Citigroup or Pfizer. That's a transaction of an equity instrument that has a portfolio of stocks or bonds or some combination of both that is bundled into a single ticker that we buy and sell with other parties on the exchange. Now, that continues as long as supply and demand are in balance on the exchange. Now, there are periods of time when there might be more investors coming into the fund or investors leaving the fund where money has to come into or out of that portfolio, and that happens in the primary market. So sitting between the primary market and the secondary market, which is where you and I are trading ETF shares back and forth, is a special breed of market maker called an authorized participant. Now, what authorized participants are hired to do is to look at supply and demand for ETF shares and to take signals from the market. So they might see premiums in the case where there are too few ETF shares to meet demand. They might see discounts in the market for ETF shares when there are too many shares in the market and they need to be redeemed in some amount. And when that signal is sent, what the market maker does, the authorized participant does, is to create new shares. They take a basket of the stocks or bonds that are in that portfolio. They hand them over to the ETF provider. The ETF provider gives them new shares of that ETF. And that imbalance between supply and demand is ultimately fixed. The process works in reverse when there are too many shares out there. So the authorized participant will buy those ETF shares in the secondary market, turn them back over to the ETF sponsor, get the basket of securities in exchange, and those ETF shares are destroyed. Now, this is very complex. For me personally, it took me at least 10 dozen times to talk through this, to fully internalize it. But what this really boils down to is it takes all of those frictions, it takes all of those negative externalities out of the equation for any investor that's going to just simply hold the ETF shares. And it does this because of this in-kind creation and redemption mechanism, where no securities are actually bought or sold directly by the portfolio managers of the fund. So what that does is that it all but, in many cases, immunizes investors that are continuing to own that ETF shares from taxable capital gains distributions in the event of large redemptions. And it turns those buying and selling frictions, the costs of managing the portfolio, inside out. Those costs are ultimately borne by investors when they're buying and selling ETF shares, and is not negatively affecting anyone that is just sitting tight and happy to own them. So the one kind of mental image I use to try to drive this home is the Pompidou Museum. So it's a modern art museum in Paris. And the architecture of this museum is unique in that the architect basically turned the building inside out. So what you see on the facade of the building is all of the guts, all of the plumbing, the HVAC. There's even main staircase and escalator that's on one of the facades of the building. So what's left inside is a very clean, frictionless environment, just white walls to hang masterworks of art on. And in much the same way, the ETF structure turns things inside out. It makes all of those negative externalities that might be forced on faithful mutual fund shareholders, and it makes them the problem of those shareholders that are buying and selling ETF shares on the secondary market, be they trading costs or be they tax considerations, tax costs. So what results is really in many cases a much fairer format for long-term shareholders. So having talked about the way that money comes out of, is managed within mutual funds and ETFs portfolios, I think it's helpful just to ground this on kind of just a quick punch list. to talk about some of the features of ETFs, some of the features of mutual funds, common and distinct between the two. So, what you see is in both cases, the primary benefit is that investors are getting scaled access to a diversified portfolio of securities. They're getting instant diversification by putting their money in one fund. Now, ETFs and traditional mutual funds can package any number of different strategies, active, passive, or somewhere in between. So I often hear questions about, is the idea of an actively managed ETF an oxymoron? It's absolutely not. You can consume now Fidelity Magellan, one of the most storied active equity funds in history, in ETF format. So the ETF is just really a vehicle. It's agnostic as to whether the strategy that it's delivering to investors is active, passive, what segment of the market it offers access to, you name it. Your frequent portfolio disclosure is something that's more common in ETFs. And when I say frequent in this instance, I mean as frequent as daily in many cases. Now, some investors may view that as a benefit, others probably wouldn't. I personally don't have any interest in knowing the entire contents of my total stock market index portfolio each and every day. But what that daily transparency does is it gives information to the ETF ecosystem and market makers in particular to understand what are the risks they're taking in quoting two-sided markets in these funds. How can they hedge those risks in order to keep spreads as tight as possible, in order to make as good of a market as possible in ETF shares. So while it might not be useful to the end investor to know what's inside their ETF each and every day, it's very useful to those people that are helping us investors find liquidity in those ETF shares. Intraday trading is a feature of ETFs that is not a feature of mutual funds, which could be bad, could be not it could be good. It really, many people are indifferent when it comes to the ability to trade their ETF shares intraday. There is that risk, risk that many have flagged that it might cause greater temptation to trade than if you had owned simply a mutual fund. All of the good data that I've seen shows that ETF investors are no more inclined to trade than investors in traditional mutual funds once you correct for just their baseline tendency to trade to begin with. Daily creation and redemption is a feature of both of these formats, as is NAV-based trading, though it's difficult to access as an individual investor. The last few attributes, which I think are interesting and speak to something we'll discuss in more detail, is the ET piece of ETFs. So ETFs are an equity instrument. So like equity instruments, not only are they trading all day during normal market hours, but there's this added level of dynamism, of flexibility around the wrapper to the extent that you can short sell ETFs. ETFs can be lent out on loan to a short seller, and you can collect income in return for lending out your shares. There are futures and options contracts available for many ETFs as well. So if you have a long-term ETF position, there are many investors that will regularly write calls, for example, to generate additional income based on that position, on that portfolio. So the ETF wrapper generally is more flexible, it's more transparent than a traditional mutual fund. It's also important to understand that it's more widely available. So investors can invest in an ETF in an amount as low as a single share, and most ETFs are generally available to trade commission-free on virtually every brokerage platform. Whereas if you look at traditional mutual funds, you might have more limited availability depending on who you're doing business with. There might still be ticket charges when you're transacting in your mutual funds, and investment minimums might be higher, especially to access that strategy at a favorable price point. So when you see like-for-like ETFs, and I mentioned the example of Magellan before, many of those actively managed ETFs are actually available at fees that are competitive with the institutional share classes of those mutual funds, and in some cases, much lower than the fees charged by the retail share class of the mutual fund. But what we see is I think longer term, the choice between ETFs and mutual funds is increasingly boiling down to a matter of personal preferences and in circumstances. Some people simply don't want to have to worry about all the ET related stuff that comes with investing in ETFs. Some people that more regularly transact, be it making contributions or withdrawals from their mutual fund accounts, or just simply more comfortable sticking with mutual funds. So it's important to understand that ultimately this choice might not be as cut and dried as it might seem at first blush. So I think it's also important to take a moment to define ETFs in the negative and say what ETFs are not. And there are many misconceptions that persist to this day. There have been many kind of clickbaity, frightening headlines talking about some sort of ETF doomsday. This one in particular, ETFs are weapons of mass destruction per senior management at a long time active mutual fund franchise. So one of the things when you see these headlines is that you have to consider the source, and ETFs have represented an incredible competitive threat to many incumbents in the asset management industry. They've created greater awareness around the importance of fees and minimizing fees. And that's really turned the screws on the asset management industry to investors' benefit. So it's only natural that when something new lands in the backyard, there's a UFO that takes up space in your backyard. Some people are going to immediately put on foil hats and be very supportive and be enthusiastic about it. Other people are going to start throwing rocks at the spaceship and hope it goes away because it's foreign. It's a threat to, in some cases, their very existence. And what I would argue is that this is not a news story by any stretch of the imagination. What I'm featuring here, and apologies, it's probably a bit of an eye chart for many, is an excerpt from a chapter of the book Business Adventures, which is a compilation of works from John Brooks. If you haven't read this book, I highly recommend it. It's got a number of timeless stories, including a corner in Piggly Wiggly, so a short squeeze in Piggly Wiggly that rhymes a lot with the short squeeze we recently saw in GameStop. There's actually even a tremendous sort of history of U.S. tax code, which is relevant today as ever. But in this first chapter, what Brooks was talking about was really kind of the go-go years of the 60s and the advent of really retail mutual funds, which had been around but hadn't really become popular. And at that point in time, the incumbents in the asset management industry who were managing portfolios on behalf largely of institutions were terrified of what they called the mutual fund situation. And their worry was that all of these new retail investors that were coming to the market and investing in these mutual funds were all going to go rushing for the exits at the first sign of duress in the markets. What the ex post analysis showed was actually that these new retail investors in their mutual funds were a source of stability when market conditions got rocky. And I share this really just to say that if you think about the headlines we're seeing about ETFs, it's a very similar story to what we saw decades before when mutual funds were first becoming popular. So I've talked a lot about the what of ETFs. What are ETFs? What are they not? Let's talk some about the why of ETFs. Why have investors now globally allocated trillions of dollars of their hard-earned money to this unique new investment wrapper? And what I would argue is that the key elements of ETFs appeal to investors boil down to four things. those being low costs, tax efficiency relative to other investment formats, to borrow a term from the late Jack Bogle, relative predictability. I'll touch on that and explain that in more detail. And then finally, access and just flexibility. So let's talk about each in turn here. So what I have here is just a chart showing the distribution of expense ratios for ETFs, index mutual funds, and then actively managed mutual funds. And what you see is that, for the most part, ETFs tend to charge far less, certainly relative to actively managed mutual funds. And in many cases, they tend to be, if not more fee competitive, more accessible by virtue of the fact that you can invest in an amount as low as a single share than open-ended index mutual funds that might be tracking the exact same index as an ETF. Now, why do I emphasize costs? Well, if there is any one reliable predictor of future fund performance that we've seen that's persisted over time, which should be a little surprise to many on this call, it's fees, it's costs more generally. The higher the costs, the higher the hurdle, or the deeper the hole that you have to dig yourself out of as either a portfolio manager or as an investor. And this comes through too, just looking at the performance of active managers. So what I'm featuring here is an exhibit from a report that my team produces in a number of geographies around the world. This is from the US report. It's called the Morningstar Active Passive Barometer. So what the Morningstar Active Passive Barometer looks at is the performance of actively managed funds, be they mutual funds or ETFs, versus the average of their indexed peers within their Morningstar category. So what you see here is success rates for active managers over the 1, 3, 5, 10, 15, and 20-year periods across a variety of different Morningstar categories. And when I say success rate, to illuminate with this with an example, if you take, for instance, the very top row, which is the US large blend category, which is really the biggest Morningstar category, is measured by where investors' money resides today. It houses everything you would think of in US large cap equities. So over the 20 years through December 31, 2020, just 12.8% of the actively managed funds that existed 20 years ago were able to both survive from the beginning of that period to the end and outperform the average of their indexed peers. So what we see here is that the odds of picking winning managers across a lot of major categories is pretty low. Now, there are certainly exceptions to that rule. What we've seen is that investors have tended to have better odds and actually do better in some of the foreign stock categories and some fixed income categories. But the general rule here still applies, is that picking good managers is hard. To tie this back to my earlier statement regarding fees, if you look at the far right-hand columns of this exhibit, what we show here is the 10-year success rate for active funds that sat within the highest cost quintiles, the 20% that had the highest fees in their category and the 20% that had the lowest fees within their category. And those boxes that are shaded in green show that in nearly every case, selecting simply at random from the lowest cost funds in a given category improved your odds of picking a winner relative to the average, whereas picking at random from the highest cost funds actually diminished your odds of picking a winning manager from that particular category, which just further serves as evidence of the importance of fees in the investment equation, especially over the long term. So tax efficiency, as I mentioned earlier, is a huge point of appeal of the ETF wrapper relative to open-ended mutual funds. And what we have here is an excerpt from a study we did a few years ago that looked at the tax efficiency of active and passive ETFs versus active and passive open-ended funds. And what you see is that that advantage afforded by the way that money flows into and flows out of the portfolio is managed within the portfolio. That in-kind creation and redemption really has given ETFs a tremendous advantage over open-ended mutual funds from a taxable capital gains point of view. I should stress that this is almost exclusively as it pertains to cap gains. You're still going to pay taxes on regular income from the funds. ETFs have no way of shielding you from income other than relying on a strategy that focuses on stocks that don't pay dividends, as an example. So what you see here is the differences between average capital gains distributions measured as a percentage of funds' net asset values between active and passive open-ended funds and ETFs, and all of the various kind of permutations of those comparisons. And almost uniformly, what you see is that ETFs have a massive tax advantage from capital gains perspective over open-ended funds. The other advantage I mentioned was relative predictability. And what I would say is that this really applies exclusively to index funds, be they mutual funds or ETFs. This is, as I mentioned before, a term I borrow from the late Jack Bogle. And when you sign up for an index strategy, frankly, you just know what you're going to get. There's no alarms, no surprises, no human drama, PM turnover. PM, either loses marbles or picks up marbles to go play marbles down the street under a different banner. That's very rarely going to apply in the case of a broadly diversified market cap weighted index strategy. You know exactly what you're signing up for. You're going to get a fair share of the market's return. And the data we've seen is that this relative predictability tends to lend itself to better behavior on the part of investors because there are fewer surprises. There are fewer things to react to, be it either rightly or in a knee-jerk fashion that leaves you with a bit of buyer's or seller's remorse further down the road. And then the last piece, the last advantage, just under the umbrella of the why of ETFs, is availability. And what I would argue and have argued for a while now is that ETF liquidity, the ability to buy and sell ETF shares all day, any day, as long as the market's open, is probably vastly overrated. The fact that ETFs trade on an exchange, though, opens up a lot of other benefits that I don't think get their sort of fair share or don't get enough attention. And access, as I alluded to earlier, is one of those. The fact that you can buy and sell these funds on a stock exchange, in many cases on a commission-free basis, in an amount as low as a single share, if not smaller. There are many platforms now, many so-called robo-advisors that allow for even fractional share trading. So you can make, $5 regular contributions into an account and invest, that $5 across a portfolio of 5 or 6 ETFs that make up almost the entire global market opportunity set. That accessibility is something that I think is at least today uniquely a feature of ETFs. There's also that flexibility, which I mentioned before, because they're an equity instrument. You can buy them long, sell them short, you can trade options, you can lend them out. And what I would stress and what I mentioned before is that it's important to handle ETFs with care and really have a lot of respect for what the ET and ETF stands for. If there's been anything in my experience that has stumped investors or caused adverse experiences, it's been a lack of caution or a lack of respect around the ET and what it means to trade ETFs prudently. So on that note, it's important to understand what are the best practices when it comes to ETF trading. What is good ETF hygiene? So it's kind of the equivalent in this day and age of wash your hands, wear a mask, stay 6 feet apart. First and foremost, what I would argue is you should consider using limit orders. Using limit orders will ensure that you get the price that you ask for or better when you're trading ETF shares. Now, there are trade-offs involved. You might not get an execution, you might not get a fill on your order as soon as you'd like, you might not get one at all, but especially with more thinly traded ETFs, it's just important to be very cautious about using market orders, because there's any number of parties out there that are looking to, in some cases, pick off smaller orders that might give you a price that is, way out of bounds and certainly not to your liking. So it's important to be, very careful. I think that the best advice I can provide in that respect is to try to always use limit orders when trading ETFs. Look before you leap, no different than anything else. Understand, what is the bid-ask spread, what's going on in the broader market. If the market is gone haywire, if we're in a period like we lived through early last year, if you don't have to trade, don't trade, because what you see, not just in ETFs, but all securities, is that when risk spikes, when everybody wants liquidity at the same time, the cost of liquidity goes up dramatically in some cases. And certainly that was the case, not just in stock and bond markets, but in the ETFs that track those stock and bonds, own those stocks and bonds last year. So try to, if at all possible, avoid trading during periods of extreme volatility. It's also important to understand that because ETFs are a basket of all of these different stocks and bonds, it takes them a while to wake up in the morning, because it's ultimately the pricing of the ETF is only going to be as good as the price information that's being generated for those stocks and bonds. So each of those stocks and bonds takes its own has its own morning routine, takes a while to begin trading hands actively. So if you can avoid trading near the open of the market, the first 30 minutes or so, I would argue that's a best practice. It's also important to I think, avoid trading near the close of the market. When many investors begin to step away, when the market makers are really just trying to pilot that ETF's price as close as possible to whatever they think its end of day net asset value is going to be. Those bookends, the 30 minutes at the start of the day, the 30 minutes at the end, I think are good periods to avoid. And then the last piece, or I'm sorry, before the last piece, it's important to understand, as I mentioned before, that the ETF's price is only going to be as accurate, as reliable as the price of the underlying. And there are some ETFs that trade when the underlying is not actually even trading. So you take, as an example, EWJ, the iShares MSCI Japan ETF. Tokyo is closed while EWJ is trading in New York. So in some respects, it serves as a price discovery vehicle. It's a way for investors to express their views on Japanese stocks while Japanese stocks are in bed for the night in Tokyo. But it's just important to understand that information that's embedded in those ETFs prices isn't necessarily always going to be based on real-time price information for what's in their portfolios. And then lastly, consider the alternatives. If investors don't place any value on the benefits of the ETF wrapper, and certainly not on intraday liquidity, the ability to buy and sell during the course of a normal trading day, consider sticking with or buying an index mutual fund instead, especially if it's like for like, the fee is similar, the tax profile has been similar, and you don't want to have all of the headaches about navigating everything I've just described in terms of good ETF trading hygiene. So before I open up for questions, and we should have a good amount of time here, it looks like, for questions, I want to finish on a few of our favorites. So these are ETFs that carry positive Morningstar analyst ratings of gold, silver, or bronze. So the signal we're sending with that rating is that we think these ETFs, these funds are going to do well for investors over a long period of time, that they're going to perform well relative to either their Morningstar category index or the Morningstar category peers on a risk-adjusted basis over a long cycle, over a full market cycle. So I've got kind of three buckets that I've developed here. The first one is just plain vanilla. These are some of the most broadly useful, broadly relevant funds funds that could be building blocks for a portfolio that's made up of as few as 3 funds. Funds that I think would fit well in virtually any investor's portfolio. So the 3 are all from Vanguard. So there's a Vanguard Total Stock Market ETF, VTI, the Vanguard Total International Stock Market ETF, VXUS. You put those 2 together, you get the entirety of the global stock market. And then lastly, the Vanguard Total Bond Market ETF, which tracks a version of the Bloomberg Barclays US Aggregate Index. You mix these 3 together in an allocation that suits your needs, your risk appetite, your return requirements, and it's going to be very difficult to beat. Indeed, if you just look at the Vanguard Balanced Fund, which is really its kind of own variant of a combination of some of these funds, there are very few portfolios that have managed to beat it, even institutional portfolios over a long period of time. And that's got a lot to do with the fact that they're all very broadly diversified, that they free ride on the market, the market cap weighted. They just take information from the market and weight their securities accordingly. And last but certainly not least, the fact that they charge next to nothing for the privilege of owning these broad market exposures. And next to nothing becomes effectively nothing when you consider all of the work that these very capable portfolio management teams do to earn back their fees, which is a specific target of Vanguard's indexes group is to earn back that fee to deliver spot on index tracking performance, which in many cases, including the case of VTI, they've done so capably. So while you're paying 3 basis points a year, in economic terms, they've actually earned that back over a number of years. So 3 great funds that I think can easily find a home in virtually any investor's portfolio. The mutual fund share classes of VTI and BND are among my top 5 holdings personally in Morningstar's 401k plan. Equity income is always very popular. As investors, we love dividends. We love seeing those checks coming in. And equity dividend ETFs have unsurprisingly been very popular as well, not just in the US, but globally. We've seen these funds amass billions of dollars of assets under management. And these 3 are 3 of our absolute favorites within this category. So again, here we've got another pair from Vanguard, the Vanguard Dividend Appreciation ETF, and the Vanguard High Dividend Yield ETF. Both funds benefit from the fact that they've got very broadly diversified portfolios, that their underlying indexes strike a good balance between trying to generate income, trying to grow that income stream over time, and keeping tabs on risk. The same applies in the case of SCHD, so the Schwab US Dividend Equity ETF strikes a really interesting balance between looking at firms that have reliably paid and grown their dividends while tilting a bit towards those that are more compelling from a valuation standpoint, using current yields as its key there. And again, in the case of these 3, the common thread, not just through these 3, through the prior 3, through much of my presentation, is that these very low fees present very low hurdles for what are all intents and purposes active strategies. They also take a much smaller bite directly out of that income stream, that dividend stream that's going to be coming off of these 3 funds. And then finally, 3, if you're just looking further afield for more kind of niche exposures, the PIMCO Enhanced Short Maturity Active ETF remains to this day one of the largest, one of the most successful actively managed ETFs. It benefits from the combination of a solid parent in PIMCO, a very experienced and capable manager in Jerome Schneider, who's been navigating in this space for years and a long time prior to taking the helm of this active ETFs portfolio. A competitive fee. So this fee is certainly competitive relative to the other ways that you could get access to this strategy or similar strategies. And what we've seen is that many investors have been using this effectively as a cash substitute of sorts, a way to get a bit of incremental yield on cash in an environment where yields are paltry. and greater yields involve taking a greater degree of risk. The other interesting option in this category, and certainly if you look at Morningstar's price to fair value estimates for ETFs, which roll up our fair values for individual stocks at the portfolio level, what we see is if there are any compelling values in stock markets today, it's not in the US, it's outside it. That applies to developed foreign markets as well as emerging markets. So iShares Edge MSCI Minimum Volatility Emerging Markets ETF, which is a mouthful, and why us ETF types tend to throw around tickers more than we do full fund names. EEMV is really interesting because it invests in a broadly diversified portfolio of emerging market stocks, but tries to reduce the level of risk of volatility versus its parent index, the MSCI Emerging Markets Index. So what that does is it tends to tilt it towards higher quality names. It tends to tilt it away from certain state-owned enterprises, which feature prominently in many emerging markets portfolios. These are enterprises that might not always have shareholders' best interests in mind. And what we've seen among a lot of these low volatility strategies is while they might not offer long-term absolute returns that are going to beat the market, by reliably focusing and reducing risk, the risk-adjusted returns are often going to be better, and in many cases, they've actually been able to match market returns. So what you see is, in the case of some of the more sensibly constructed low and minimum volatility portfolios, a better Sharpe ratio that comes out the other end. And lastly, if any of you are considering something that might be a bit more tactical, whether value stocks are making a comeback or not is anybody's guess. It's been a long, dark winter for value stocks. But one of the more interesting plays in this space is just a broadly diversified cap-weighted basket of the market's smallest and at least based on fundamental measures, cheapest names in Vanguard Small Cap Value ETF, VBR. It's a fund that carries a Morningstar analyst rating of gold. Again, we like broad diversification. We like market cap weighting. Turnover is very low, and the expense ratio is very low as well. An interesting way to tilt towards smaller, cheaper names that may or may not be making a comeback after a very long, very rough stretch that they've suffered through. So with that, I've come to the end of my prepared remarks. I'm eager to hear what's on everyone's minds, what questions you have. Just about anything's fair game here.
Okay, thanks, Ben. I think what Bruce and I will do is we'll go through the Q&A. There's been a few questions that have been posed there. And why don't we start off with, I had a good one. There's no, so one question kind of theme here is, what do you see as the advantages favoring mutual funds? You talked a lot about the advantages of ETFs. I don't think that necessarily means mutual funds are not advantageous to some degree. So what's your thoughts on the advantages of mutual funds?
Yeah, it's a great question, and a question we get a lot. Does this mean that mutual funds are going to go the way of the dinosaur? And what I would argue is that that's absolutely not the case. And what it really boils down to, mutual funds' durable advantages are twofold in my mind. One of them has to do just with like the plumbing of retirement plans in particular, and in 401k plans specifically. So 401k plans are set up to invest dollar amounts on a regular basis, like into something that is capable of accepting investments in dollar amounts. So the plumbing in 401k plans really lends itself far better to mutual funds, at least as it stands today, than it does to ETFs. So mutual funds, I think, will continue to have a home in 401k plans. Now, that said, what we see is they're actually losing share not to ETFs, but they're losing share to CITs, or collective investment trusts, which is just a different way of like delivering the same portfolio that brings the cost down for retirement plan participants. So at least in the retirement plan space, I think mutual funds will persist, especially for kind of, sort of mid and smaller tier retirement plans that can't like get to the scale to offer their plan participants CITs. And that's got a lot to do with plumbing. It's also got a lot to do with the fact that the advantages of ETFs, like they really don't mean anything in the context of a 401k plan because it's a tax preferred wrapper to begin with. So tax efficiency doesn't really mean anything. You don't want to have to worry about trading ETF shares again. 401k plans are plumbed to deal in dollars, and odds are that you've already got funds that might track like benchmarks that are priced at the same level. They have the same fees. So that's one area I think where mutual funds still have an advantage. The other big advantage mutual funds have over ETFs, and this is really, I think, kind of, it's something that I've been talking about for years that I think has become very apparent only more recently, given the success of ARC and ARC Financial and their family of funds, is that ETFs cannot say no to new money. So the portfolio manager cannot close the fund, be it a soft close or a hard close, when they're worried about what they're going to do with any new money that's coming in the door. So some of our top rated managers, many of the best portfolio managers of all time, including, I've mentioned Magellan a few times, Peter Lynch, have made use of their ability to say, you're giving me new money, but I don't have ideas right now as to what I can do with that new money in order to like continue to deliver the type of returns you expect from me. Sorry, like come back later when I've got either new ideas or more capacity. And we've seen that in the case of ARC Financial, is that they've had to kind of widen out their opportunity set, invest in larger cap names that they otherwise wouldn't have invested in before they saw tens of billions of dollars flow into the door. And they haven't been able to say no to that new money because ETFs by definition cannot close. Absent certain extenuating circumstances like the Arab Spring in the Cairo Stock Exchange closing forced temporary suspension in new creations and shares of a US traded Egyptian ETF. Like that's an extreme circumstance. That's not something a manager can do at their discretion. So if you're looking at active strategies that have limited capacity, I think the mutual fund is still going to be the better way to invest with that manager in that strategy. And many mutual fund managers, for their part, because they know they can't close an ETF, if they've got a lick of sense, are never going to offer capacity constrained strategies in an ETF.
Yeah. Thank you. One of the things that I find when, particularly on the sort of the bond and income side of the financial world, is that the mutual funds tend to do a better job of managing overall volatility than the ETFs. So for example, let's take a junk bond mutual fund compared to, say, HYG or JNK. Typically, the mutual fund volatility is about half of their ETF counterpart. And so I think from an investor standpoint who's looking to manage volatility, mutual funds also provide some ability to do that a little easier. But turning that into a question for you is, I wanted to get your take on why is that the case? Why is it the case that a mutual fund, or let's say, why is an ETF twice as volatile as their mutual fund counterparts?
Yeah, it's a great question, Rob, and you've hit on an interesting area of the market, specifically in high yield. So if you look at, you mentioned one of the tickers, but HYG and JNK are the two kind of big gorilla ETFs in that space. Both of those funds actually carry a Morningstar analyst rating of neutral. And we've rated them neutral, which indicates like we don't have a positive view, we don't have a negative view, we're indifferent, for many of the reasons that you've described. So if you look at the high yield market in particular, it's an area of the market where active managers have been able to more reliably add value to investors by either reducing the amount of risk in the portfolio or otherwise kind of coloring outside the lines. So investing in certain securities that might be out of benchmark. Things like bank loans, for example, feature in many actively managed high yield portfolios. So it's just simply an area of the market that doesn't lend itself not well to ETFs, but just not well to indexing more generally. So it's an area of the market where we've got a lukewarm take on the index portfolios in there. We've got some more favorably rated managers that tick a lot of the boxes that I've just described. It's also when you look at those ETFs, another example of just kind of the dynamism of the ETF wrapper that I mentioned before, because it's open to anybody. So it's not really like a lot of like individual or intermediary like advisors that are investing in those ETFs. Those ETFs are actually being traded back and forth by like institutional bond desks that use this as a very like easy and liquid way to push baskets of junk bonds back and forth between one another. So a lot of that trading, a lot of those assets are actually coming from like big institutions that don't care whether or not they're going to outperform a benchmark. They just want exposure to like, junk bonds with a capital J and a capital B, and are less concerned about, what's the return profile, what's the risk profile, where does the manager see opportunity. So, ETFs, kind of open up, to the entire market, and many ETFs are used, more so by, again, like institutional traders than they are necessarily, individuals or advisors. And, you look at the oldest of them all, SPY. So if you back into, the average holding period for SPY, last I calculated it, I think it was maybe 14 days. So every 2 weeks, SPY's entire share base turns over. And that's not because like you and I are trading it. It's because institutions are using it, in lieu of futures, or they're doing arbitrage trades. So, a lot of what you see in the ETF marketplace isn't just, your average investor. It's kind of the entire ecosystem, and it's people, from other markets too. That's the other thing, by trading on exchange like a stock, there are a lot of ETFs where, 10, 20, 30 cents on the dollar might be coming from an insurance company in China or a sovereign wealth fund in the Middle East, you name it. It just speaks to the fact that they're this open format.
Yeah. Okay, thank you. There was a question asked here about the Morningstar Large Cap Growth Index for the ETF JKE, changed from equal weight with about 50 holdings to a market cap large mid cap of about 431 holdings in March. It seems that there were already several similar ETFs. What ETF would you recommend that replicates the old JKE?
Yeah, great question. In one where, full disclosure, like I can't make that recommendation, one way or another. So, for purposes of separation of church and state, like Manager Research, my organization sits outside of Morningstar indexes and is expressly prohibited from having any sort of qualitative opinion on any either Morningstar indexes or ETFs that are underpinned by Morningstar indexes. So, while I would love to be able to comment, I can't. There are certainly other kind of broad growth, equity growth ETFs that we rate favorably. Among them, off the top of my head, VUG, the Vanguard Growth ETF, which possesses many of the traits of the other Vanguard ETFs that I spoke to a moment ago, is a great option for those just looking for kind of broad-based growth exposure, within U.S. equities.
Okay. There was a question here. A few people were curious about the Vanguard Wellesley being used for emergency fund, and even use it for some of the bond part of their retirement account. Any ETFs that mimic VWINX or have the same strategy, if you're familiar with the Vanguard Wellesley?
Yeah, that's. I mean, it's a great fund and it's a great question. Off the top of my head, I can't think of any that I would hold out as being, a decent substitute for that fund for a variety of reasons.
Yeah. Okay. Thank you. I don't know what happened to Bruce. Bruce was supposed to be here helping me with the Q&A today, but I guess it's just you and me.
No, I'm here. In fact, I'm interested in the question that's at the top right now regarding thoughts on Michael Burry's 2019 warning about systemic risk in passive ETFs. And Andrew Lindemann has given us a link to a money column in US News about that.
Yeah, so I remember very well when Michael's comments came to the fore, and Michael's been one among, as I mentioned earlier, really just a chorus of investors, academics, others that have raised these fears. There was a report famously out from a analyst at I believe it was Alliance Bernstein a few years ago that asked whether or not indexing was worse than Marxism. So it's been taken to extremes, and at the end of the day, like the market is the market. So the more and more money that is going to be invested in index funds, like at some theoretical limit, it's going to create issues related to the concentration of ownership, be it at the level of asset managers or individual funds, be it just with respect to price discovery, like is there enough information that's getting baked into individual securities prices? But at the end of the day, like the market is all of us. It's people. It's the people that are expressing their opinions with their money, like arriving on prices. So it's going to correct it at some point if it goes too far. Now, what is too far in terms of either the growth of indexing or the growth of ETFs? The short answer is no one has any idea. If you look at the entirety, for example, of global equity market capitalization today, indexed portfolios, be they ETFs, mutual funds, private mandates, big global pension funds managing indexed portfolios internally, make up, call it somewhere between 20 and 30% of the entirety of the global stock market. And that's been growing over years. If you look at like what really matters, which is like where prices are made, index portfolios, because they tend not to turn over much, tend to account for anywhere between, call it 5 and 10% of global equity trading volume. So I think it's safe to say that we are still a very far way off from any tail wags dog type scenario. I think it's fair to say, based on our long history with markets, that if we go too far, markets have a way of healing themselves. Markets have a way of correcting. Like, what is that theoretical limit? I had the opportunity to pose this exact question to Gene Fama, the father of the efficient markets hypothesis, when I interviewed him a number of years back. And he said, in theory, it would only take one smart active investor to set prices and everybody else could index. Now, that's probably a bit extreme, but suffice it to say that there's a lot of space between where things stand today and that one super smart investor. And when we cross whatever that line might be, I think markets ultimately are going to correct themselves. They're going to heal themselves. And there's just all of these other variables that we have to take into account too. That's been made readily apparent, this year when we've seen, everything from sort of GameStop to Tootsie Roll, which, to native Chicagoan, I should have known that Tootsie Roll was a publicly traded company. Never in a million years would I have guessed it would turn into a meme stock for a brief period of time, to now Dogecoin. Like, people right now all over the world are, hoping that Elon Musk is going to say something about Dogecoin on Saturday Night Live tonight. Like, it's just proof positive that people are markets at the end of the day. Okay. And that markets, are generally efficient over the long period of time, but between here and there, like, we're going to have, a lot more, GameStops and Dogecoins and, Piggly Wigglies and Volkswagens and you name it. So.
Okay. I see here that Mahindra Agrawal has asked two related questions, and that those two are related to one of your earlier slides about constructing a 3 ETF portfolio, and he's asking about what about just buying SPY or the Qs in a simple portfolio, and then he says he's checked that SPY and VTI and SPY beats VTI over almost any time period. Do you have any comments on that?
Yeah, I mean, I think the important question is, like, as we know, past is not precursor. So, what gives you the greatest odds of future-proofing, your portfolio? In my mind, what gives you the greatest odds of future-proofing your portfolio is just owning everything, paying as little as possible, and let the market do most of the heavy lifting, which is why we've got a very favorable view of VTI and other total stock market index funds, though we've got equally favorable views in many cases equal ratings on many of the S&P 500 trackers, be it SPY, be it IVV, VOO, SPYG. What I would say is if you're choosing specifically among S&P 500 ETFs, make fees your friend, and if you're owning SPY or buying SPY, you're paying too much. And you're also investing in a somewhat antiquated structure. So SPY is actually structured as a unit investment trust, which prohibits the portfolio managers from reinvesting dividends before they distribute them to shareholders. It also prevents them from lending out stocks to generate income for shareholders. So if I had to look at those four, SPY, SPLG, which is kind of SPY's younger sibling, IVV, which is the iShares S&P 500 ETF, or VOO, which is Vanguard's, I would point people away from SPY and towards one of the latter three, given just its higher fee and its older structure. Investors are going to do better with that one over the long term. Cubes is just like a completely different animal, an animal unto itself. If you ask somebody to build a portfolio, like starting from scratch, you would probably fire them if you said, well, we're going to limit our investment opportunity set to just 100 biggest stocks that only trade on this exchange. And we're going to come up with this cockamamie weighting scheme that makes it look even less like the investment opportunity set that not just exists on that exchange, but just in US stocks more broadly. You look at QQQ, and I would argue its performance has been tremendous. There's no arguing that, but it's been kind of a random accident. It's not something that you would do if you were going to construct an equity portfolio, like looking to the future. And I would argue it's certainly not future proof too, because as we've seen with like the Dow recently, something like an Apple share split can all of a sudden reduce Apple's weighting in the Dow. Something like a choice of listing venue. So Honeywell just moved over to NASDAQ as its primary listing venue. Whether Honeywell gets added to the cubes, I don't know yet, but someone could equally decide to move away from the NASDAQ, and to have that affect kind of your portfolio and your portfolio outcomes is not kind of thoughtful, future-proof, sensible portfolio construction in my mind.
Great.
We have a neutral rating on the cubes, by the way, which admittedly has made us look very bad for a very long period of time.
Okay. So just to confirm our time, Ben, you've got about another 5 minutes. Is that correct?
I do. Yeah. Apologies to cut it somewhat short, but softball pitchers are calling on a Saturday afternoon.
Gotcha. No worries. No worries. Let's see. There's a question here. Recently, Vanguard opened up to allow their mutual fund holders to be transferred into an equivalent ETF without tax impacts. Obviously, this is targeted for non-retirement accounts. What are your thoughts on this? Any gotchas that people should be aware of?
Yeah, I think it's important to understand that once you convert, you can't go back. So that's very important. all the work we've done just to try to understand like if there are any frictional costs, tax costs, like it's free and clear. And what you see too is that there's a bit of a carrot in some cases for investors. So in certain instances, if you own the Admiral share today, the fee on the ETF share might be a basis point lower. That really isn't much in the grand scheme of things, but every little bit helps, especially if it's going to compound for 10, 20, or 30 years. But just to understand that on the other end, you're going to own an ETF. The way that you're going to transact in that ETF shares is going to be different relative to how you would buy and sell shares of the Admiral share of the fund. The way they can even do this is because they've got this unique structure that was patented by Gus Sauter years back, whereby the ETF is just a share class of the mutual fund. So it's hard to see like any flashing red lights. There's nothing I would be particularly concerned with. Just know you can't go back. Know you now own an ETF and what that means for when you want to sell those shares. To the extent that Vanguard's not charging commissions on those transactions, that's obviously helpful. But nonetheless, there's going to be kind of bid-ask spreads to negotiate. Just a little bit more work you might have to do when it comes time to liquidate.
Great. Bruce, do you want to kind of bring us to a close with one final question?
Sure. There's a question here from Gary Hornick. He's asking the difference between an ETF and an ETN.
Yeah.
I didn't know.
Great question. The short answer is notes are not funds. So ETNs, the N stands for notes. You just think of it as like an IOU that was written by a bank. So these banks write IOU the return on XYZ index. I'm going to charge you a certain amount for it. And then there's a whole lot of fine print that in many cases basically says, when the bank decides they no longer want to owe you whatever it is they've committed to, that they can call that off, that they can redeem the note in certain circumstances. So notes should be approached with a tremendous amount of caution, just based on the way that they're structured. Not just based on the way they're structured, though, is that oftentimes the underlying exposures are incredibly risky. They're incredibly esoteric. So there might be leveraged exposure to the VIX or leveraged exposure to a certain commodities contract, you name it. Notes are really just a way for banks to try to make money off of things they're already doing, and make money off of you in particular. And the benefits, in many cases, to the end investor are really, there aren't any, frankly, other than you might get access to something you otherwise wouldn't have access to. It's probably something you didn't want access to begin with. The one exception I can think of, at least historically, was certain notes that were set up to give people access to a diversified basket of MLPs. So the note structure was somewhat more favorable in that instance, just given the way that MLPs are obviously taxed, the way that funds are structured, the way that income is shared with investors. But that is the one and only exception I can think of. Know full well that notes are not funds, know that they're promises made by banks that aren't actually backed by any assets, and promises that are made by banks that can be broken when making that promise is no longer profitable for the bank that made it.
Okay. What's the Vanguard ETF for growth?
So VUG, the Vanguard Growth ETF, that's the ticker for that fund. And that covers kind of, large to mid to small to micro, all of the faster growing names, of the CRSP US Total Stock Market Index.
What was that ticker again?
So it's V as in van, U as in U-boat. I always use U-boat, and G as in Gary.
Okay.
Okay. Well, that brings us right to our end time here. Wanted to thank you, Ben, for sharing your thoughts around ETFs on a Saturday morning with us. We really do appreciate it. Thanks for everyone for attending. Look forward to seeing you either at the Risk Management SIG coming up in June or at our next meeting in July. If you could take a couple minutes to fill out that survey, that should be presented to you as you log out today, and enjoy the rest of your weekend.